The latest tax legislation brings major opportunities for families, business owners, and retirees, but only if you plan ahead. This week on Life Planning 101, Angela joins the SLAS podcast to break down what's changed and how you can turn tax savings into long-term financial confidence. Please enjoy. Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Welcome, everybody. We have a very special guest today, Angela Robinson. And Angela and I have known each other for probably about 15 years, and we've served on different committees and boards together with some different professional organizations. And we actually have been in a study group together for a couple of years. And she's the first person I know who read the Big Beautiful Bill Act. She took her 4th of July weekend to dig into it and see what was all in there. She is a little bit nuts. I still haven't read it. I rely on people like Angela to tell me what's in it.
Or I'm just a nerd, Jim. There could be that.
It could be. But she does planning very similar to the way we do planning. You know, we're big believers in control what you can control. And the one thing you can have a lot of control on is how much you pay in taxes with a little bit of planning, whether it's today's taxes or future taxes. I've always said begin with the end in mind and figure out what the least amount is you have to pay along the way and at the end. But most people get so busy accumulating their wealth, and then all of a sudden someday they got to pay a big tax bill. Well, with a little bit of planning, you can certainly reduce that. So with that, I want to welcome Angela. Thanks for joining us today.
Of course. I'm happy to be here. It is truly just a passion to help empower people with something so complicated as this financial world and tax world that we live in. So thank you for having me on, Jim.
All right. So Big Beautiful Bill, as Trump affectionately calls it. A lot of stuff in there. I believe it was somewhere around 900 pages, right?
Yes, it was. A fun fact before we dive in, it actually doesn't have a name because you can't be a big, beautiful bill and a big, beautiful act. You have to be one or the other. So there is really no name to the legislation if you look at it. So we can call it whatever the heck we want to, but we can call it B3. We can call it whatever you want to, but.
All right. So one of the biggest things I see is just the extension of the current tax rates, because we were bracing ourselves, and I don't think many people really realized how big of an impact it would have been if we would have went back to the old tax rates, because, you know, people don't realize that there's two ways to raise taxes. One is the rates you actually pay, but then also when do you start paying those rates? And one thing that, I look at right now, a married couple can earn around $400,000 and still be in a 24% bracket. But the way the law was going to be changed, if you had taxable income of just under $80,000 as a married couple, any income above that amount was going to be at 25%, where right now, at that level of income, it's still at 12 today. So more than double what a lot of people that are in the middle class today, if you're a married couple, most married working class people as a couple are making over $100,000. So that would have had a tremendous impact on them. Plus the standard deduction would have been lowered. A lot of people would have been paying a lot more in taxes. So this bill that became law, I think that's probably one of the most significant things, but there's also new things in there as well. What's your take on it?
Yeah, no, you're 100% spot on. I found it very interesting that in order to pass the law, they couldn't even use the same rules that have always applied because it's under what they call reconciliation. So the House and the Senate have to balance the budget. And in order to do it, they kind of had to shift because the increase of debt it was going to create in our nation, because they're just looking at losing all that taxable income was so insurmountable, they wouldn't have been able to pass it. So they had to go ahead and pretend it was expiring to then pass the new legislation to make the balance or the budget balance, because it was going to be trillions of dollars. But that's trillions of our dollars, right, as taxpayers. And I think that's exactly what you're talking about is everybody would have felt that. I think most importantly, who would have felt it is the mom and pop business owners, because there was the Section 199A, that nice little 20% deduction that you've been getting since 2017 on your business income that was going to go away. So that means, 20% more of your income was going to be taxed. And not only that, but like you said, it was going to be taxed at a higher rate. So those things were really impactful. I remember back in 2016 when we were running analysis to see, we were kind of picking, okay, let's look at this business owner, let's look at this executive, let's look at this family, retiree, etc. Who's going to pay more taxes and who's going to pay less taxes? And we served at that time, about 350 families. We had two people that ended up paying more taxes after the Tax Cuts and Jobs Act out of whole 350. So that gives you an idea of what, people would have felt if this would have expired. So it's huge. I think the biggest thing that I see when people hear that, though, is they think that because that's done, they just have nothing to do. They have nothing to do with their planning or shouldn't do anything with their planning because they can just say, oh, tax relief. Well, that's the worst thing that you can be doing. I've been preaching since 2017, and if you had taken up my offer on recommendations at that time, you'd probably have a lot of money in your pocket, because I said, why not take that tax savings and start doing something with it? Pretend that you didn't get it. Pretend that it did go away, and be able to make sure that you're taking care of the things that you need to be taken care of. For some people, that's just an emergency fund. For others, it's long-term health care insurance to protect the old person that you're going to be today, someday, right? To some people, it's putting back more for their retirement or helping their kids. I see a lot of people today really worried about their kids that would oh my gosh, what was the average age of the man living at home with this child I saw this week? It was in their 30s. I'm like, what is this? But that's the world we're living in. And I think there's so many things that can be done with the almighty dollar, but we tend to forget just some basics. And that is like going back to a budget, going back to, here's your income and here's where every dollar's going. And let's make a difference with the dollars that are left. And everything goes so fast through these devices we have in credit cards that we don't do that. So I encourage you not to hear this today and say, oh, I just get this relief. I encourage you to hear this today and to say, okay, I need to take a look at this. And had this expired, I would have had this coming out of my pay anyway. I would have had this going to Uncle Sam. Well, rather than it going to Uncle Sam, how can I repurpose this for the good of myself or the good of my family? And I think that's the biggest takeaway if you don't do anything else.
Well, and that goes kind of along with that old adage, pay yourself first.
Absolutely.
Everybody pays all these bills and does all this stuff, and then they try to save what's left, and there never seems to be any. You really have to plan on doing for yourself, establishing your goals for yourself, your family members, your favorite charity, whatever it may be, and then put a plan in place and make sure it's taken care of and be in control of it. Now, I know another piece that's going to affect most of our listeners, so it's not just this new bill that just passed, but it's also the Secure Act has been gradually phasing in, the Secure Act 2.0. And there's a lot of things that can be done with the combination of those things. And then we have the old 529 plans for, parents and grandparents and other family members can help with the education has been dramatically expanded to make it easier to plan for those things. And if you haven't taken a hard look at that stuff, now's the time to do it. And even though there's been an extension of the law, there's also been some new provisions. I just think of one, even though it's a little small thing, but like right now, starting in 2026, my understanding is you can give $1,000 to your favorite charity, both a husband and a wife, out of any account, and it's fully deductible. It's not part of the itemizing. One of the problems with this new bill, and probably the two people that you got that would have paid more in tax, it's probably because they were still able to itemize.
That's right. So, and I'll speak to that for just a second. Jim, you brought up a few really awesome points there. So the cash deduction to charity actually starts this year, and you get $1,000. Next year goes to 2,000, which is really good. The other thing to note is we will have a floor for charitable gifting. And this is actually negative. Okay, it's on your itemized deductions, but this is the first time ever that we've had this. And so what happens is, let's say that you're going to give $1,000 to charity. Well, there's a $50 floor. So in other words, your deduction is only going to be $950. Okay, now once you've hit that 0.5% floor, then everything else is deductible. Now the other thing to note is that 0.5% floor carries forward. So once you've done it once, it's basically going to help you in future years kind of bump up. But the reason I bring that up is I was running some analysis this week and advancing gifts using a donor advised fund this year to get the full deduction of what we wanted to do so that you didn't lose that 0.5% or take the risk of not being able to carry it forward. And I say that and you may say, well, I'm going to charitably gift every year. Well, the standard deduction is going to $36,000 for a couple. So are you really going to be getting your charitable gifts next year? I mean, some people will, but some people certainly won't. Another pro to maybe you will is they've also allowed that the state and local tax, maximum was 10,000. They've increased that back to 40. So maybe you will. Maybe that will help you itemize. I'm not a New Yorker, but they said the average New Yorker pre-2017 was paying $28,000. The average New Yorker, not the guys that are wealthy. The average New Yorker was paying $28,000 in state and local income tax. So that could be huge. So you could be using those charitable deductions, but you need to be doing that planning now, especially if you've got some major liquidity event. And I mean, I don't know about you guys, but I'm seeing there's definitely some areas in technology, AI, that have gone up like crazy. What a better way to be able to gift than to give appreciated assets. If you've got something with 200, 300% appreciation, you gift that over into that donor advised fund, and then you get the deduction for what you gift, but you're also avoiding the taxation on that gain, and then you can reset your portfolio. So there's some really good things to be doing there, and you need to be looking at those as well. You mentioned on the 529s and the expansion of that. That's huge. This is the first year ever I put money in a 529, but I'm going to tell you why I did it. I did it to get a state income tax deduction, and then I can turn around and use it on my junior high student who is doing a online academy and for all his tuition and books, etc. And I can use it on my special needs 9-year-old for all of his services. So the expansion's massive. And if you haven't looked at that for the planning.
Was that an ABLE account then that you did?
No, a 529, straight up 529. Now you can, I think there's some terms around, you can roll those into ABLE accounts now. That was in that Secure Act, I believe. And then you have the ability to take a piece of it and convert it to Roth if you don't use it. But 529s used to be so restrictive. And I was like, oh, are they really going to use it? Is this going to happen? Well, with what they are now, especially like with technical schools and all these things that they can do. I mean, even credentialing, like there's so much out there. It's phenomenal. So take a second look at those 529s, and especially if you're paying state income tax, because now you might get to itemize that deduction, et cetera, and double dip here.
And the other change that just happened, I think it was last year or this year, that now it used to be, and it still is, for parents, if you set up a 529 for your kids and they go in to apply for student aid, the money in those accounts can count against them. However, if grandparents put the money in, it doesn't count against student aid, or non-parents, I should say, but specifically grandparents can do that. And then it used to be that when money came out, it would count against them on their student aid. But now they just changed the rule that money coming out of a 529 that was put in by their grandparents, that does not count against them at all. So for those of you that got grandkids, all the more reason to do those 529s. And one of the things Angela just pointed out, they expanded them greatly. Another thing they expanded, trade school can be paid for. We see a lot of things where a lot of these skilled trades, we're way short on workers, and they can make a lot more money than a lot of these kids coming out of the 4-year program with a degree. And if there's extra money in the account, we can put up to $35,000 into Roth IRAs for them. I believe the account has to be established for 15 years before they can do that. But if you started early and they don't go to school already at 18, you could start putting money in. But even if they got to wait 15 years, or the kids need to get continuing education or decide to take a few years off and then go to school, one of the great things about the 529, unlike the education IRAs, which was the first attempt, I think, to kind of deal with this issue, we don't have to use up the money by any specific age. So it can really create generational educational funds. So great tools. So going back to, charitable giving, that is really expanded. And of course, don't forget, you also have charitable RMDs. They've continued to expand what you can do with that. I know we've talked on this program many times about doing conversions. And now that we continue to have this extension of these lowest tax rates that we've had for most people's working careers, if you look at that and take advantage of it, and that's something else to really plan, is look at where your tax brackets are, anticipate what brackets might be in the future. Just because you get the deduction now doesn't mean it's going to be better for you later. You may be in a much higher tax bracket. All we had to do, I was talking to a lot of people, they're deducting this stuff at a 12% bracket, and had these brackets expired, they would have been taking the money out at a 25% bracket. So you really got to pay attention to that. And it's not like you set it and forget it. I mean, how many people, this is the way they've done it since the beginning, because we made a decision 10 years ago that this is the right way to do it for us. You got to look at it year to year and make sure that you're optimizing. And some people pick all of one, all of another. We have a lot of clients where, depending where their brackets end up, we might mix and match to really optimize the benefits of the deductions and then what the taxes will be coming out. So
absolutely. Well, and I would like, on that note, so there's the senior deduction. It was promoted as no tax on Social Security, which it's a misnomer, because it's really just a senior deduction. If you get old enough, you get to deduct some money. And so we've got this in there now, but there's some phase outs on it. If you're single, it's $75,000. If you're married, it's $150,000. But if you fall under those phase outs, to your point, use that deduction for Roth conversion. Why not? It's free money. You would have never known it was missing the first time around. So pretty powerful there. And then if you add the SALT deductions on top of that, that could be some pretty serious Roth conversion. So remember what I said at the beginning of the show. If you do nothing else, pretend like you don't have these deductions already and start putting that money back for yourself.
Explain what the SALT deductions are.
Oh, I apologize. So SALT is the state and local tax. So that's where it was capped at $10,000. And everybody was screaming in New York and California about this, but I'm going to tell you, I come from the great state of Texas, and I have seen some property taxes that are $40,000, $50,000, $60,000. So, and that was pre-2017. So it has affected a lot of people, and so they've lost that over these years. Now, your standard deduction has gone way up, and it's set to increase pretty big each and every year. So that's going to be, battling it out. But either way, I mean, you end up, I think it's worth the tax planning. Look at it, make sure you're ready for that Roth conversion. And the other thing I tell people when we're talking about Roth conversions, Jim, I'm sure you do the same, is like we talk about that kind of planning for 2026 now. Like we're working on that now. So If we hit a market downturn in January early, we want to convert to Roth when we have that market downturn, because that's converting on sell. So let's say that you own some stock and it's down 30%, then you literally are not paying taxes on that 30%. You're putting it in a Roth IRA, and then it's going to grow tax free. So if that stock comes back up to 100, you gained way more than what you just paid in taxes. So be ready, be prepared, and know what you need to convert so you can take advantage of opportunities when the market hits. And I'll give you an example. Last year, remember when the tariffs came out and everybody was scared to death of, oh my gosh, our world's about to fall apart, country's about to fall apart. So the markets, of course, took this nice, beautiful dip. Well, we had this wait list. And it was just like, okay, hit the button. Boom, 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 boom. As many Roth conversions as we could do when a time that market dipped for, what was it, a little over a month, and it was 20% down. So those are those types of areas that, being able to take advantage of those are really powerful, but you got to be ready for it. You got to plan for it ahead of time.
One of the things I was just thinking about, and I know it's only temporary, that extra $6,000 per senior, the extra deductions on their standard deduction. So the one thing I was thinking about as you're talking about it is there's phase outs at the certain income level.
Yes.
Okay. For those of you that aren't collecting Social Security yet, or at the age where you're eligible for those deductions, anticipating stuff like that is usually pretty important because, for example, Social Security taxes on that are optional. If you make too much modified adjusted gross income, and for a single individual that's 25,000 and 32,000 for a couple is where that all starts, and they've never adjusted that for inflation since they started taxing Social Security in 1986. You can hit that pretty quickly. So the thing is, if you've got these IRAs, you got this wonderful thing called required minimum distributions that for people that aren't retired yet doesn't happen till 75. And people always say, oh, that's wonderful. The government is there to help us. We can delay having to take money out and we got more years. But all that meant is your required minimum distributions are based on life expectancy. So back when it was 70 and a half where you had to take money out, the interesting thing about that is our life expectancy was a little bit longer than someone who's 75 years old, because now they just shorten the amount of years that you have to take money out, which means you got to take more out each year. So the thing is, people that are getting to that required minimum distribution age that are close to those phase outs, maybe you want to do some conversions because your required minimum distributions are based on your year-end balances. And if you convert it, that means there's less you have to take out. So getting ahead of the curve and anticipating what's down the road next year, 5 years, 10 years down the road, and putting a plan in place, especially with some of these they all seem like little things, but if you add them all up, it can make a huge difference over time. And I always tell my clients that it's not just your money, it's your family's money. And if you want Uncle Sam to be part of your official family, then do no planning because there's trap doors out there. So
that's right.
What are some of the other things about this bill that might be new or different that people should be aware of?
Yeah, there's a lot about this bill. That's a loaded question. One of the things that I think you're going to see more talk about, and I think it's worth talking about, are the Trump accounts. And I kind of want to couple this up with the estate tax exemption amounts as well. And the estate tax exemptions, I'd go back to what I said, when we were talking about the pre-2017 and doing something with the opportunity that you have, because estate tax exemptions were permanently doubled, which puts them at about 26 million for a couple, meaning if you have 20.
Angela, when you say permanently, that's in quotes, right?
Yeah, I was getting to that, right? I was getting to the fact that nothing is permanent in Washington. Yeah. So let's just keep that in mind. You're totally right. So yes, so it's 26 million for 2026. Whew, say that 5 times fast. But that's for a couple, right? So if you have under that amount in assets in your estate, then technically you aren't going to be paying estate taxes at the federal level. Okay? I'll mind you, the 18 states still have estate tax, and that is a growing area of revenue for some of these states. So you need to know what is going on with your state, first of all. Second of all, is you just said it, nothing is permanent in Washington, Jem. Quotes, permanent. So use it. Take advantage of it. There are all kinds of ways. And I'll tell you a little story. So this is the coolest thing ever. We started working with a family back around 2012. And the husband had passed away, and mom and all her kids have sat around that table for 13 years with us and planned. And we are transferring an estate well over $20 million just in mom's name, and not paying estate taxes on this estate. And at this last meeting that we're talking about, and she's not doing well. She probably won't live very long. And so one of the things that has always been a question is, if you do that kind of a planning, do I give up control, or what about income taxes? Because it could increase income taxes, and those are legitimate concerns. Well, I'm going to tell you, mom has plenty of access to money, and she's staying at home in care, has a full-time caregiver. Everything is the way it was intended to be, and she's going to be plenty taken care of. And we are literally working on a plan right now that is not going to add a single dollar to an estate tax bill, and is also going to allow them at the same time to get a full, what you call, step up in basis. So there's no income taxes either at the passing. Those are huge things. So many people, I think, are afraid to do estate tax planning because they feel like it's permanent. Maybe they don't want to think about themselves in the grave. But you said it, Jem, is that we live in a world today that, it's generational planning. We just talked about the man that was 30 years old living in the basement with his parents, not because he wants to, but because he has to. So where's that money going to come from to the next generation? We're blessed. I think anybody that is over a certain age can say that our money comes from the great generation, but the baby boomers love to spend it. So, and they had 3 kids on average, right? So then it's even divided up further. So you have to ask yourself, where do I really want this money going? Do I want it going to Uncle Sam, or do I want it going to my kid that's having a hard time getting a start, or my grandkid that it's even going to be harder for? I look out, and I travel, and I think about people getting a start today. Just a start, getting their first home. Holy smokes, how hard is it, right? So you hit the nail on the head here. Sometimes this isn't about as much about you as it's asking yourself, how much do I love my family? And if you do, you want to do this type of planning to really help them out. And you've got a huge opportunity to do it. And I say that opportunity window is shrinking every day, because permanent could mean 3 years away. So you better get after it when it comes to estate tax planning. And take advantage of the vastness that's there now, right? The other piece to that is the Trump accounts, and I'll circle back to that, because those Trump accounts, I think this is just something, again, it was like a checklist for the administration to say we created something. These are good for a few reasons. If you have a baby that's being born here in the near future, or was born this year, supposedly the government's going to give you $1,000 to put in that account. But when that child turns 18, they get access to this account, and they have to use it up pretty quick. It's within so many years. So it's not really a long-term, I would say, investment strategy, retirement planning, or even maybe educational, because there's no caveats on how they kind of have to use it. There's some little taxes in there that are like, it helps you out, but nothing powerful. But I think the bigger thing to watch out. Oh, and the other benefit is that an employer can put money in there for you and it not hit your paycheck. So that could be big. But if it's not for those two things, the thing you need to watch out for is if you could have an estate tax problem in the future. And I would say if you, and this is just a total wild guess here, but if you have a $10 million plus estate, you don't need to rule it out. Because I know what the other side of the aisle wanted to do back at 7 million, $3.5 million a person. I don't think they'll quite get there, but I think 10 million is something you need to kind of say, okay, I need to always keep in mind estate taxes could be an issue. And you may disagree with that, Jim. That's just kind of a thinking I have with everything that's gone on in Washington over the years. But with those Trump accounts, though, if that's the case and you gift to that Trump account, you have to use up some of your lifetime gift exclusion to do that. It's not a gift that can be counted this year. So you have to file an estate tax return to gift to a Trump account. Get that. But I don't think they thought that one through very well. But in other words, do not proceed without pure caution is the point.
Well, the one thing I would disagree with on you, Angela, is that I don't think anybody's safe from estate taxes that are listening to this program, probably. You always have to watch for it. And I have people do stuff proactively, even if they're far away from the exemptions, just in case they change. And part of that is because as recently as 2007, we had state inheritance tax, and it was on estates over 675,000. I looked at some of those states that have the inheritance tax, and their exemptions, for the most part, I believe, are all well below the federal level. I know we used to have states that charged both estate taxes and inheritance tax. I believe there was two of them as recently as just a couple of years ago, but I think now they only dip in once on the estate tax side. But we have, I look at all the deficit spending. They're always looking for more money. And I've always had the saying is dead people don't complain. They don't vote. They're not interviewed on CNN. They're the easiest people to tax. And if you're an heir of someone who has estate taxes and you start complaining, people think you're greedy and privileged and all that. It's just a no-win situation for the family that's facing it. But what most people don't see or the press doesn't cover, but they're hitting those estate taxes. A lot of times, the people that have estate taxes, they have businesses. Those businesses are illiquid. It's not like they can just walk into the business and take $1 million out, and there's people that work for those businesses where their jobs depend on it. And when all of a sudden you have estate taxes, a lot of times the sufferers of that is when the kids have to sell the business. They're probably selling it at a discount. Those workers, chances are a lot of them are going to end up losing their jobs and all this. It has a lot of negative impact. And one of the reasons the federal government has raised the taxes is they have done the studies. When you don't have workers, you're not collecting income taxes. And they've done the studies that what they actually collect probably hurts them more than it helps them. And that's why we've had this change. But politicians are very short-sighted. So a lot of times they see that immediacy. Let the next senator worry about it. I won't even be in office then. So I think that's a problem that we probably won't solve today. But I think we barely scratched the surface. But I think you and I do completely agree on this. Planning, not planned. It's a process. Every year you got to look at it. We're having major changes, and some of them are a little bit intertwined. When we talk about this Trump account, you look at 529s. There's been changes to 529s. We look at what's happening with charitable giving, the standard deductions. All these things are changing. And then you got this Secure Act where they're phasing in, tax credits, actual deposits that can go to your account for people under a certain level of income. And, that level of income where you start qualifying for this stuff has been raised dramatically. It's either 70 or 80,000 as a couple. You can qualify for this. And that's taxable income, not gross income. So I had a case, and this was under the old rules, where I had someone literally contribute $500 to a deductible IRA and got a $750 refund because it bumped them into a higher tax credit. Plus they got the deduction, and the tax credit bumped up on prior contributions that they had. And you look at that, if you could do that every year, who wouldn't do that? So
that's exactly right.
Yeah, so you need to be reviewing your stuff, making sure you're taking advantage of this. And this doesn't even count the fact that the whole healthcare system and the tax credits have now pretty much expired. And most people are going to see dramatic increases in their health insurance premium for
If
those.
they haven't already.
Huh?
If they haven't already, holy smokes.
Oh my God. I look at, what the premiums are, and it isn't so much the premiums. There's one carrier available for my county, and the doctors in my network are not in there. I did find a group that I'm eligible to maybe get into where I can maybe solve that problem, but healthcare is gonna become a challenge. So planning has never been more important, in my opinion, than it is today.
Absolutely. Absolutely. And I'd add one more thing. We didn't touch on this, and this is really important, and it kind of goes back to those itemized deductions, or it does, is because we really didn't touch on the high income earners. People that are in that 37% bracket, you're making over $650,000 of taxable income a year. You now have a cap on those itemized deductions, and it's pretty large. So it's important, when we're talking about that state and local income tax deduction, for example, where it's $40,000 for most people, yours is 10. Still, you don't get the increase. And then on top of that, and you saw that floor that we talked about for charitable deduction, but then on top of that, then they're going to, I'm going to tell you this equation just because I think it's worth warranting. Of course, our government would write something this complicated. You would take the lesser of 2/37, yes, that's the equation, 2/37 of $100,000 of itemized deductions, or 2/37 of the excess over $650,000 of taxable income. So if you sat at $1 million, for example, you'd take the 2/37 of $350,000, and that'd be your cap for itemized deductions. So yeah, I don't think CPAs are going out of business anytime soon with all this complication, but it's definitely something, because I know, we work with high income earners, and one beautiful consistency that I see is their love to give back. And so that charitable gifting will be capped, and it needs to be planned for, because there's definitely things that you could do to be able to try to maximize that gifting. But if you wait till January 1, you're past that time.
Well, thanks again, Angela. I know normally we go about 20 minutes, and we still have, there's so much more in that bill, but if you don't take anything else away from this, take this away. Sit down, do some planning, make sure you're on track, make sure you're optimizing the things that you can do, especially with these changes, to realize that the goals that you have for yourself, your family, the people you care about, the organizations you care about, there are a lot of opportunities to make a difference. And don't just let whatever happens happen, because there's so many things you can do to get you on track. So with that, any final thoughts, Angela?
You said it. Plan. Have FOMO, fear of missing out. You need to develop that over this bill. FOMO of the BBBA. Yeah, get Absolutely. That in your head.
All right.
All right. Thank you, everybody. Jim, for having me on.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Don't forget to learn how our sister company can assist you with all of your tax and consulting needs. You can find out more at briscoeandassociates.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.